people watching and listening to us may have seen a few notes from me this week about new ways of generating yield and looking for excess returns on your investments and on your cash, using an alternative financial system to achieve the kinds of yields that you could never get in the banking system, at least not now. You used to back in the good old days. And I think there's never probably been a more important time for people to look at all the tools and weapons that are available to them, and use them. And it comes in a variety of forms. It comes in. Welcome to the Exponential Investor Podcast. Want to be a better, smarter, more clued up investor? Well, you've come to the right place. We cover the breakthrough investment ideas you don't hear about in the mainstream to keep you on top of the megatrends and opportunities reshaping our world. Good morning and welcome to another episode of the Exponential Investor Podcast. I am your editor, Sam Volkering, and my regular co-editor, Kit Winder, is back after a week's hiatus, of which we had James Allen come on and talk to us last week. But Kit, it is very nice to have you back on with us again, and lots happening all over the world, as no doubt, well, hopefully you switched off from a lot of that while you were away. But I wanted to kick off today, and I wanted to look at China. China, because there's a lot of stocks that are listed on the US markets that are Chinese companies. So Alibaba, Baidu, JD.com, and they have been hammered so hard. So we've talked a bit about the big sell-off in tech and the volatility in markets, but the Chinese stocks have taken an absolute battering. I think the Alibaba price is lower than its IPO price, and it's getting pretty close to all-time lows. I mean, when I see something like that, right, my first mind sort of process is there an opportunity here? And I think there might be, but I don't think it's probably now. What's your take on China? Do we write off China now? I mean, are they too tightly linked to Russia and what's happening in Russia there? Is it a regime that can no longer be trusted in the markets, or could maybe never have been trusted in the first place? But what do you sort of make of the situation with the Chinese stocks?
Well, firstly, you're right. I mean, the fall in Chinese technology stocks has been extraordinary, and we better not forget what's happening with property in China, with Evergrande leading all of the property developers.
Sure. Further
Further down the hole, I mean, the media spotlight has rightly moved to other places in the world, but that property crisis in China continues, and the debts of those property developers are getting no more attractive in investors' eyes, at least. But you're right in that when, you know, a major country with one of the best economies of the last 2 decades sees its tech companies fall in price by 60, 70, 80%, the whole index. I mean, firstly, it's a reminder of what can happen for investors who are looking at, American markets down now. S&P's down sort of 10 or 11% from its peak only, despite the incredible conversations that have gone around the terrifying decline. But, you know, when something that major has gone down that far, we're certainly right to look at it. And I think just in the last week, Chinese regulators and their policy committees came out and sort of, with a number of measures, implicitly said that they would support the market. So it was about, regulations on tech companies coming to an end, or the increase in regulations was going to end soon. It was about supporting the property sector. It was about keeping liquidity at levels that were accommodative rather than destructive. And there were a number of other things as well. So sort of the incredible power of central banks and policymakers to support financial asset prices is something we've discussed a lot, mostly in America, but in China, it's almost even more true. The growth in debt in that country to support financial assets, mainly property, has been extraordinary in the last 20 years. And it was sort of reinforced, I think, by the powers that be in that country. And so perhaps now the renaissance for those shares begin, or perhaps the other side of that coin is that they are a leading indicator of what's to come for tech markets in our own countries.
It's interesting that, a lot of people probably look at China and think, oh, geez, I'm glad I don't own a lot of Chinese stocks, but if what maybe some investors aren't necessarily that aware of, and we spoke about this actually recently as well, about understanding and knowing what your fund invests in. If you've got any money in any kind of not ESG, any kind of emerging markets fund, I remember, I don't know, maybe you're a bit too young for it, but do you remember when the first, brick ETFs started to launch and become popular? China makes up such a massive component of a lot of those emerging market funds, because it's still classified weirdly as an emerging market, but they have been eviscerated along with the individual tech stocks themselves. And it just like, it looks, when you look at the chart, it looks like the chart from 2008, 2009 during the global financial crisis. And when you look back at that chart, and you can almost find you can find a perfect bottom in the US markets in particular around, I think it was March 2009, where basically the market was just completely smashed to bits. And it looks a lot like that now. And I've got this weird working theory, which I'm trying to test, that March, during periods of absolute market crisis, that March is the point of which we achieve these unbelievable lows. The 2020 pandemic crisis also saw March be the bottom of that particular market, albeit they kind of bounced and now we're sort of back there again. What do you think? Is March the time to look at these insane discounts, if you want to look at it that way, and look to get back into some of these positions?
I know that certainly there are sort of seasonality trends that over 80 years have sort of built up, where some months are better than others, but that's at best a sort of tip in the hat, 1% in either direction. I would be nervous to say that anyone should think buy in March and see you later. But
I'm going to prove my theory at some point. I'm sure of it, but yeah, we'll see how that goes.
The old sort of adage was sell in May and go away, or was it buy in May? I think
it was around the sort of half year sort of mark, depending on when. I know that certainly rung true in the Australian markets, because the corporate financial year in Australia runs from July 1 to June 30. And so you kind of offloaded a lot of your stocks in May, getting ahead of the June crowd that were looking to basically crystallize their capital losses, so that come tax time, they were carrying forward losses and then offsetting them against any potential future gains. But the UK, it's weird how all markets run on these weird different calendar and financial years, and so maybe those sorts of those sorts of particular month picking is not the best way forward.
Who knows? But certainly, I mean, you mentioned, are we looking at a bottom for stocks right now? I mean, we're seeing just very recently that progress has been made with peace talks, a sort of 15-point plan drawn up between Russia and Ukraine, Ukrainian neutrality. And it sort of seems as though that conflict has not gone the way Russia has hoped. Obviously, they're now sort of pleading with foreign mercenaries basically to come and help them out. But that would provide the lift for stock markets, at least in the short term, that they've been looking for a couple of weeks. And you mentioned Chinese tech stocks; they were up more than 8%. One of the tech indices, a whole index up 8% on Tuesday after the news from regulators that they were going to be more supportive in future. So who knows? Maybe there is a sort of bounce on the way. The question is then whether that is a mega discount low, or whether that's one of the bounces on a continuing way down, because when the Russia-Ukraine crisis ends, hopefully it does, we're back to worries about rising rates. We're back to 7.9% inflation amidst the Ukraine war. A new higher inflation print was read out in America. And the surge in oil prices and energy prices in general certainly won't have helped. So the picture is, if anything, getting worse on the inflation side in the last month. So if we can, and I hope we can, leave the Russia-Ukraine crisis behind, we don't go back to an incredibly happy picture anyway. So is this a discount and a low, or is this sort of bounce on the way down? We will only be able to find out later, sadly.
Yeah, only time ever tells in these sorts of things. And it's interesting you mentioned that, if eventually this conflict will end, contrary to, I'm sure many people believe that it is world war that will rage on for years and years and years. Maybe not, but but eventually comes to an end. And when it does, have no doubt that the market will be kind to those things. And as we've written about an exponential investor recently, you've got to be aware that some of the systemic problems that still exist in the economy that were there well before any conflict kicked off or any conflict increased its intensity over there. Rates are heading higher now because they're trying to control inflation, but inflation is out of control. So they're paying little service, I think, to the severity of that, and a small rate rise here and maybe one there isn't going to do the trick. But it is certainly going to cause an impact. And I think it's topsy turvy, right? Because if a conflict ends and then all of a sudden gas starts flowing again and the oil price starts to come back down again, so the petrol pump's a little cheaper, I bet you it doesn't go back down to £1.40 or £1.50 for a litre of diesel. I bet you it stays up above 160. They never tend to come down as fast as as far as they go up, these sorts of prices. And the cost of your shopping bill, your energy prices, I don't see those. I don't see my gas bill halving in the next few months, because it pretty much doubled over the last, or almost tripled over the last year. So there are some systemic issues, I think, that people still need to really consider and factor in. That there seems to be a lot of people sort of putting a lot of impetus into the fact that this conflict will end and what it's going to do, but there are still some really major issues with how central banks and the government are dealing with economies off the back of. A lot of people forget that economies were shut down for 2 years. That impact doesn't just disappear overnight when all of a sudden, a lot of those restrictions are eased. So there's some pain to come, and it's interesting because, and people watching and listening to us may have seen a few notes from me this week about new ways of generating yield and looking for excess returns on your investments and on your cash, using an alternative financial system to achieve the kinds of yields that you could never get in the banking system, at least not now. You used to back in the good old days. And I think there's never probably been a more important time for people to look at all the tools and weapons that are available to them, and use them. And it comes in a variety of forms. It comes in investing in the market in the smart way, investing in the right kinds of sectors and asset classes, whether it be stocks and shares or some of the ETFs. I know you've been looking at some big thematic ETFs as well recently, and then looking at alternative options in the alternative financial system. So we talk about cryptocurrency, which for a lot of people is still risky and scary, and they're very fearful and don't believe in it. But I think when people start to understand what is available to the everyday investor and how it can work to their benefit, that it'd be crazy not to think about how you can leverage that to your advantage. And again, you can see that in our coverage this week in Exponential Investor. There should probably be a link at some point somewhere around this video to learn more about that. But yeah, it's one of those periods. It feels like it's a very uneasy time at the moment, Kit. But I mean, surely there's reason to be optimistic still, isn't there?
Yeah, I mean, always. And maybe one group of people have the most reason to be optimistic are gold investors. I mean, you talk about investing outside the financial system, and I think one thing that maybe has gone a little bit unnoticed in this whole crisis was that America cancelled Russia's central bank. They cancelled their foreign reserves, and so they're essentially telling the world that if you hold your reserves in US dollars or in US treasuries, US debt, we can sort of cancel them. We will if we don't like what you're doing. And so quite a lot of central banks across the world will be thinking maybe they're not actually the safest asset to hold in the world that we thought they were. And the obvious thing that people will turn to is gold. So, that sanction, which went alongside cutting Russia out of SWIFT, will be making a whole lot of regimes think that they shouldn't be only sort of holding their asset reserves in US dollars. They should also be holding things like gold, and maybe that'll push them towards newer, more digital alternatives as well, Sam, that I know you'll know more about than me. But that certainly, I think, is something that gold investors should pay particular attention to, and all investors, in fact, because we started the conversation by talking about China, but America cutting a country as big as Russia out of the financial system is going to have very profound impacts for the global financial system, and China will be a beneficiary. Already, we're seeing talks about China, I think, building a new refinery with Saudi money, and that's to sort of refine Russian oil, but that will all be priced in yuan. So China will be looking to seize on this opportunity of, the Americans cutting one country out of the dollar system to increase the relevance of their currency, the yuan, in the global financial system as well. So that is a change that has been accelerated by this war in Europe. And for gold investors and for people who are sort of looking at the macro, the sort of the multipolar world idea of US versus China, that is also a very significant development as well. So maybe that's not the most optimistic thing, but definitely something I wanted to mention on this podcast before I finish.
Yeah, and I think we might pick that one up next week and maybe have a bit more of a discussion around the idea of because Russia has been cut out of all financial networks and rails and payment system, from SWIFT to Visa to MasterCard to there's financial sanctions imposed on them, and they've obviously turned to China to support a lot of that system for them to continue to operate their economy, as much as it's getting absolutely obliterated as well. So there's certainly something there to talk about next week, perhaps, with obviously China implementing their digital yuan, their central bank digital currency, and how that's perhaps a precursor for what we can expect in the US, in the UK, in Europe, and pretty much all over the world around the idea of central bank digital currencies, and the good, the bad, and the ugly of all of that. So we might pick up on that topic in the next week or two, for anybody listening. So anyway, we've gone on long enough today. Thanks very much for your input again, as usual, Kit. It's nice to have you back. And everybody that is watching and listening to us, thank you for joining us. We'll be back again with you next week with another episode of the Exponential Investor Podcast. Thanks for watching. Bye for now.